Welcome to the Trading Zone. I'm Joe Teague with you at the noon Eastern time. Hope you're having a great lunch and a great start to the trading week. We're going to be here every week at noon, but we might have some quick pointers out in the morning, quick VIX discussion in the morning. Anyways, great to be here with you all. Brian, how are you doing this morning?
Great. Markets are kind of quiet today, basically flat, waiting for some data to come out later in the week, which we'll get into in our show. Excited about our new time here, Joe. Noon Eastern here. Make sure you tune in every Monday with myself, Brian Stutland, and Joe Teague, colleagues here, portfolio managers at Equity Armor Investments. What do we got here?
Yeah, well, so of course we're following volatility like we do. We're getting a tick up in volatility this morning. Not a lot going on in the market. The volatility ended the week last week very low. Just reminding everyone we're heading into September. September is a month of heightened volatility.
We like looking at this graph all the time because it kind of gives the chart of events. And there's been this like little bit of lag before volatility sort of changes course when we get some news, and there's sort of some time to adjust. It doesn't happen instantaneously. Although we tend to think that volatility leads the way, but you can see the basically the jobs revision has led to lower volatility now in the last couple of months. Maybe it's just the summer season as well, Joe. I would expect volatility sort of pick up in the typical season of September, October. So we're preparing for that.
Yeah, I mean, the fun thing about this is this next point, this next spot, I don't know what it's going to be, really. Like a lot of these things we just came out of nowhere, very surprising. Even if you were following all these things, you were kind of surprised by the fact that they happened or the market reacted to them in that way. So it's going to be surprising, this next point. I suspect there will be one, if not in September, late August, or sometime in early October. There's probably going to be an event we're don't really have our eyes on, but we should be ready for anything just in case.
Now, what do you make of the put activity, though, that we're seeing? Because we are seeing the skew kind of tick up, or at least hold its own. It did tick up. It's kind of backed off a little bit, but still at higher lows. What do you make of that?
Yeah, this is just the trend we've been seeing for all year long, going back 2 years now, when volatility is coming off. This tracks the VIX very closely. Of course, this is the put activity 1 month out of the S&P 500 compared to the call. So 25 delta put versus the 25 delta call. Right now, people are not so interested in bidding up the downside put, or maybe they're a little more interested in calls comparatively. So anytime we get offside one way or the other, you kind of see a correction in the market or turnaround in the market. So we're getting close to that area right here, Brian, kind of a softening out. Maybe there's a little more interest in puts right now ahead of the CPI. Maybe there's a little less interest in calls. One or the other is happening.
Yeah, I mean, look, you don't have to trade the skew or no, optionality like in its like total entirety here, but we use this as sort of an indicator of volatility is going to shift in the marketplace. So we would see this skew index tick up, sometimes ahead of the VIX itself, actually, as put buyers, institutional traders come in to bid up for protection. So nothing unusual, but definitely holding higher levels. So anytime we kind of get a news event, it seems like we get a higher pop in volatility.
And with volatility, of course, we always look at the VIX futures curves. Of course, you know us, we're former VIX market makers, options market makers. And we're seeing the VIX kind of in line with where we've been over the past couple of months, not stepping out of line. This is basically what the market's been expecting for some time, which is surprising.
Yeah, it was interesting because the VIX futures a month ago or even a couple of weeks ago were trading at significant premiums to where the VIX itself would be, meaning that these futures would have to come down and settle into the VIX index cash at expiration. So it was almost as if traders were predicting a somewhat volatility event to start August, maybe even into September. We did get that little bit of volatility pop. Our signals, Joe, said to take the VIX futures off at that point. We were right. It's amazing how quickly this futures curve has come back down, more in line with where the VIX is at. So people were just expecting maybe a little bit of a pullback. We got a smidge, and now the markets have been racing higher, although today kind of grinding along and doing nothing.
Yeah, we're kind of a week out of expiration here for the VIX, and it's kind of just similar. We get this like flatter spot for the front month of the cash. A week ago was interesting. Of course, volatility was really elevated. A week after that, this downgrade on the jobs number. Man, things happen so quickly. But you had this elevated VIX and was trading, very close to where the future was. So maybe the futures were saying, hey, this is going to pull back a little bit because we're not racing up higher, keeping our trend. So interesting to see. This is basically what the market has expected here. We got a little bit higher volatility than we're used to in 2024 and earlier, and the market's just kind of pricing this in throughout these further out months that volatility will be higher than the spot cash is currently.
Yeah, I wouldn't be surprised. I mean, this is interesting about this curve, though, because if you look at 1 month out, 2 months out, a week out, it's higher, right? The VIX futures are higher. This is a mean reverting kind of product, meaning it tries to kind of go back to its middle ground. So I could see this red line here, popping back up into the 17 range very easily and quickly with any hint of bad news in the marketplace. And then, you see that out in October, November VIX futures saying, yeah, that could happen.
And if you're a fan of our show, you've been following us all year long, you noticed that we've been kind of targeting this is the range where the VIX will be. We know the VIX to mean reverting. Yeah, this is the bottom end of the range. So we absolutely expect a little bit higher movement here off of this higher end of the range. We also expect September, October to be higher volatility than July, August. It's just historically the way that it's been. We'll see if that plays out. Now, if you were watching us last week, we did a quick recap of why bond market volatility is very important to the stock market. Essentially, it's a layer of liquidity. The lower the bond market volatility, the more liquidity there is in the market. The more liquidity there is in the market, we match it up very closely. The higher the PE ratios are of the S&P 500. So essentially, the lower this MOVE index goes, the higher the PE ratios go. We saw that last week. This MOVE index collapsed last week. The market rallied last week. PE ratios were going higher everywhere. So we mentioned last week, hey, we're kind of seesawing up and down, heartbeat up and down here in this MOVE index. Maybe there's room higher in these PE ratios. We should be ready for that if that happens. And now we're, heart beating. We're on the lower end of that range. Now we're on this bottom side. Maybe if we do turn around after CPI, we could see these PE ratios correct and come lower.
And Joe, you write a weekly just info letter to anybody that's signed up. That's actually free. You can go to equityarmorinvestments.com and get Joe's insight. He talks about, we call it the ripple effect, which is the blog that he writes to. And the ripple effect meaning that you can't drop a bowling ball in one part of the pool and the ripple not at least extend all the way to the other end of the pool. So watching volatility in the bond market is just as important as watching volatility in the equity market. Using this sort of indicator as a way to determine whether valuations are cheap or expensive in stocks is a pretty good way to do that. So make sure you go and sign that up. That's totally free. Go sign that up. We do also have a subscription that gives actual trade ideas. That's why we call it the Trading Zone. We call it our Trading Zone trades of the week with continual updates right into your inbox. So you can go. That part is paid, but you can get the free newsletter weekly by going to our site.
Yeah. Help yourself. Please go ahead and check that out at your leisure. I was trying to pull it up, but it's not coming up right now. So look into that. But yeah, this is, of course, what's going on this week. Big stories. We'll kind of see whether or not the market likes this or not. This is really kind of fresh, but AMD gaining access to China, NVIDIA allowed to sell their chips again to China, but they're going to pay the U.S. government to do so. Really fascinating. I'm not really seeing a trade deal like this before.
Yeah, this is kind of interesting, right? I mean, it kind of came out, yeah, you're going to pay 15%, and all these stocks went up today. So maybe the marketplace was just expecting more of pain. Trump recently announced 100% tariff if you're not manufacturing in the U.S. This at least maybe gives some clarity who's going to be in on that, who's going to be out, who's going to avoid it. So clearly, NVIDIA, AMD, a couple of the players that are going to be continue to be able to do business with China. Just, they're going to have to pay a little bit of a tax on that.
Yeah. So it seems to me like it's good to have the U.S. companies making the chips. China's going to be playing in the AI. Maybe they're going to try to catch up with Huawei. Maybe they're going to get their own companies to make these chips. So I'd rather they're using the U.S. chips, even if we're giving them their older version chips, the less powerful chips. They'll still be able to do a lot of work with those chips, obviously. It's interesting to see, though. Yeah. So first of all, I'd rather U.S. chips in China doing the AI because I want them to disincentivize them from producing chips on their own from Huawei. And all, it's just maintaining the U.S. edge in the chip making. Obviously, that's very important. Yes, this AI race of like artificial generative intelligence, that is crucial. It's kind of like people aren't really talking about it, but the chatbots are kind of cute. They're not really what the story is with AI. Getting a much more powerful, intelligent computer processor is the end goal. China's racing us in that. So it's good that we're using AI chips. I think it's just interesting to see, okay, on top of that, we're going to collect some money from these companies. I think they're happy to do so because they're going to make money in China. The question is, what are we going to do with that money? Are we going to put that into some sort of fund to try to further our advancements in AI, to try to maintain that competitive edge on China? If that's the end result for this 15% tax, I think that could be fantastic. Kind of building up a fund of research and development money where we can really be on the offensive and maintaining that competitive edge in this race.
Yeah, definitely.
So yeah, anyways, I don't know what's really going on. I like the fact that these chips are being sold in China. I think that's good for these companies, good for the U.S. Future, maintaining on top of the AI. But just what are we going to do with this money? That is a question I don't really have the answer to. Also, big news today. Obviously, I don't have the answer to this either, but we're having more talks here with Ukraine, Russia. It'd be fantastic. Obviously, if this were to get done, I think there's a lot of skepticism right now whether or not that's going to happen.
Yeah, I know in here the headline is that Zelensky is rejecting ceding land. To me, it just seems sort of silly. Like, what you're just going to say, Russia, give it back, and then Russia, let's just make a peace deal. I mean, Russia went on the offensive for a reason. I'm not saying they deserve to get the land. I don't know, like, really what you do. Do you just keep fighting till you get the land back because Russia's not going to stop? So at some point, if you want to call it truce, unfortunately, you have to admit you kind of lost, right?
Yeah, that's a great question. It seems to be painful for both sides, though. I think Russia's feeling the pain at this point. They have been for a while in continuing this war. But I think for them, it's been so costly. What is going to be the goal? If they just go back to where they were before they started the war, it would be seemingly impossible for them to say we've expended all this money, all this blood, and nothing happened for it. So yeah, I think Russia has to get something for them to do it. I mean, while by the way, they happen to be occupying that land, so it doesn't make sense that they would not be ceding land if there was going to be a deal. But if Ukraine just says we'd rather keep fighting, that's I guess their prerogative. But maybe Trump has some cards up his sleeve saying, hey, we're not going to fund you to do so. Yeah,
it's just a shame that so many people are losing lives over this, and it really hasn't gone anywhere. Hopefully they can come to a resolution here. But, obviously, if I'm looking at it in terms of the market, it hasn't had much effect, although maybe if there's a peace deal, maybe that makes the market go higher. I mean, when you look at these key events, that's really what the story is for the markets. The CPI, the PPI numbers, we're going to be watching that, Joe, right? Because if inflation can come in kind of tame, the jobs are kind of weak, that's going to give fuel to the fire for Powell to cut rates in September. Maybe we start to get some Fed governors coming out and saying, yeah, we actually might cut rates in September. So we'll see how that kind of plays out.
Yeah, I think oil potentially could go significantly lower. Oil, obviously, it's not necessarily in some of these inflation metrics, but it is really tied to so many of these things because it's, for transportation, it's a key critical input. So, that would be great to get this war ended. I think that would lower inflation, even if some of the tariffs are going to temporarily increase inflation. I think once we get this tariff news behind us, the Fed will have a little bit more ammunition. But I do think there is a risk, though, putting all things together here, that the CPI comes in a little hot and the market says, oh, maybe we were pricing in 3 cuts or, cuts sooner than we thought. And maybe it'll take a little longer to get these rates down. So I do think that is the risk also with the MOVE index being so low. And, I also brought up in the blog, of course, Brian, that the market is very highly concentrated in these AI stocks. You call them the Magnificent Seven. If you actually add in Broadcom, AVGO, it's like the Great Eight, the Elite Eight, whatever you want to call it. That's almost 38% of the S&P 500 right now. Those 8 stocks, all heavily tied to the AI trade. So a lot of risk if there is just a little hiccup in that trade.
Yeah, it's amazing the concentration risk there. And like you mentioned, let's say inflation does come in a little hot, bonds rates tick up, you may see a volatile move. Now the move index volatility increases in the bond market, that spills over, and now valuations have got to come down. And the S&P that's sort of trading right around all-time highs, if you look at it right here, maybe that stalls out in a little double topish, kind of formation. So we're at a key critical level. I do think if we can push through new highs, if you sort of measure, 6,400 down to 6,200, you could get a quick, easy 200-point move up just as well right now if those numbers come in, somewhat tame. If they don't, then I think 6,200 becomes in the cards as sort of a test that we sort of, are topping out, and we got to figure out if we can kind of hold these levels.
Yeah. And isn't this kind of just amazing how the market tends to repeat itself a little bit? Just look at how look what happened in April. We had this big correction. Obviously, this is a lot steeper, like 10, 15% here. And then, a little hiccup and then kind of off to the races. Market kind of is acting similar. We had this, 3% correction. Is that, a huge correction? Not necessarily. But yeah, we had this sharp pullback, and then we had a little climb. And then, it's really looking poised like absolutely we could just bust out and have another leg higher, just like we saw here.
Yeah. Yeah, exactly. That's actually a really good rinse and repeat metrics, right? Because that was almost a 200-point range between 6,000 and 5,800, right? Where it backed off, it went through, it busted through, retested, and then really took off. That is upside risk, right? That's why when we trade volatility as a hedge, Joe, that's why we don't give away the upside. So many of these funds out here will sell a call and give away the upside because they don't know how to reduce the cost of buying insurance and protection in the portfolio. So they do some sort of call sale, some put sale, or something that exposes them to the wings. And we don't do that at all. Like, we manage the volatility position, the long volatility position that costs money to buy, but we do that in a way that's efficient such that we can continue to participate in case you do get that rip higher. And this is just like a mini little V turn to the next leg up. So, you got to watch out for that.
Yeah, another thing is going back to like that 60-40 thing, the 40%, almost 40% being the top 8 names in the S&P 500. Yeah. Those names are very heavily weighted to data centers, very heavily weighted. They are like the makers of like the chat bots, right? So maybe these chat bots aren't where the profit's at for AI right now. You're looking at Palantir. Okay, Palantir's got an insane multiple. Amazing results, don't get me wrong, and I hope they continue to do those results. Hope the multiple ends up being justified. But a company like Palantir is proving that utilizing the data, creating some efficiencies really in like a real-time, high-speed way is like a really cost-effective or really profitable way to be using this AI. And you can really stretch that out across the S&P 500, going through sector by sector, finding companies within each sector that's going to be benefiting from the AI, like Equity Arm Investments has done, Brian. And we have selected stocks by sector to have a better way to play the S&P 500 to play this AI trade without being oversaturated in these top 8 names.
Yeah, certainly.
And by the way, hint, stick around to the end. We'll get a trade of the week with one of those names potentially, kind of just maybe like a rotation trade if inflation is not the way that we hope it to go.
Sure. Yeah, when you look at the NASDAQ, same thing. That actually almost looks like it already has made the V turn up, right, Joe? Where it's done what it did back in May. The market's a little like pullback, correction, takeoff. NASDAQ poised, looking very good.
Yeah, I mean, and it just makes perfect sense. We had this sharp sell-off, knee-jerk recovery, and then like the next sell-off is like, okay, there's a lot of new believers saying, hey, whatever reason we're selling off for here back then, tariffs are going to be crippling to the economy. And then, we get the pause and people think about it again and say, maybe it won't be as bad as people think. and you get this higher high here, and then it's, people, number one, they take off their shorts. Number two, they find new reasons to buy. The exact same thing happened again, of course, here. And, obviously all-time highs. We potentially are off to the races here in the NASDAQ.
Yeah. I mean, I think there could be maybe one little pullback back to like where it just broke out right there, where you made that last little mark.
Sure.
Maybe if I was a day trader, I might want to wait to jump in for that pullback. Mm-hmm. But 24,000, man, that looks good.
Well, yeah. Well, like we're saying, anything is possible here tomorrow on the CPI number. We could absolutely see that happening right after the print.
Sure.
But just Maria, these sell-offs have been bought though. Just kind of pointing that out. There sometimes can be a rotation, hinting to the trade of the week. So we'll be watching out for the potential for that too. Of course, the semiconductor index, we got the same story going on. Love to see it make a new all-time high. Very similar to action to what's going on in the S&P 500. But this was just a crucial level here, Brian. Getting through this area here, very impressive rally here. Over late spring, early summer. So just absolutely loving this. And we're hope, maybe even just staying up here at this level for some time would be good. But obviously best case scenario is new all-time highs.
Yeah, certainly semiconductors leading the market, really. I mean, almost leading Bitcoin, really. It told us that Bitcoin was going to make new all-time highs, which we, looking over at the screens here, 120,000 on Bitcoin now. The semis leading, those two things have kind of like moved lockstep with each other. Mm-hmm. So, and then boom, Mag 7 index. We talked about this lagging, Joe, and now it's finally busting out. Does this mean the entire market is moving higher?
Yeah, well, it absolutely. I mean, this is 40% of the market. So yeah, this is absolutely crushing it. This obviously represents the risk of the market if it does turn around. But yeah, this is leading us higher. You mentioned Bitcoin. You'll love to see it. This is absolutely risk on. It's a very risky way to play risk on. You know my feelings here, Brian. But this is a sign people are comfortable with putting assets to risk here.
Yeah.
And speaking of the inflation, just actually this morning's price. Where's do you have a live price of gold here?
Gold itself is trading 34.07. That's the gold futures contract, the active contract that's traded.
Yeah, so it's a little lower today. So down about 310. So we're watching this as we go. But yeah, this is certainly a sign. If inflation turns out, I guess it kind of depends. This might not be inflationary, CPI dependent. I think it's more what the Fed's reaction to the inflation data is going to be.
It could be a hint, Joe. I mean, gold's down 2.4% today. So maybe this is just traders selling the rumor of that the CPI number is going to come in weaker than expected and inflation is not going to be as hot.
Or maybe maybe they're saying the Fed will not be able to be as dovish because inflation is. Yeah, so that's kind of the thing. It's for me. Is the Fed ahead of inflation expectations or behind? Is kind of me as the way I'm playing gold. Like if the gold traders think the Fed is too dovish compared to where the actual inflation data is, I think gold will be higher.
Yeah, well, I mean, certainly gold has this range. If I was like a little trader on this, right? You see GLD get above 315. I'd probably be a seller. It gets down close to 300. I'd probably be a buyer using probably like a call spread though, in case it breaks the 300 level and moves significantly.
I'm definitely a long-term bull here because I'm leaning on the side that the Fed is going to be a little bit too dovish compared to where the actual inflation is.
Okay, yeah. I mean, look, that's where they've leaned for under Powell forever. So yeah, why not? Maybe it just needs like a breather, like on a fundamental reason. That's been so anti-fiat currency, which is gold, that it just has need a little breather for like the money to keep getting printed.
Yeah. So maybe the Goldilocks CPI for gold is in line with expectations, and the Fed can say, okay, we won. There's no more inflation. So yeah, I'm not sure. We'll see how it plays out, though. I do want to talk about the CPI number on our trade of the week, and I kind of think if it's in line or worse, we might see a little bit of a rotation trade, Brian. Might see people trading out of some of the tech into some of the safe harbor areas of the market now. But within those safe harbor areas, it doesn't mean you don't have to participate in the AI trade. I think we're all thinking so hard about NVIDIA of the world and the data centers of the world, but there's more in the ecosystem about AI, Brian. There is you have to power the AI. You have to be able to turn the lights on for these data centers. You have to be able to turn these machines back on, get back in there and keep them running, Brian. So I'm looking at utilities. Now these are going to do fine no matter what. If these chatbots, if the AI trade is a big flop, the utilities are still going to be making money. So I'm thinking if there's a potential for a short-term rotation, I'm looking at CEG. They had just fantastic earnings last quarter. They weren't really rewarded by them at all. So I'm just going to be playing it to modestly play to the upside. Now for a utility company, obviously it's had tremendous growth lately, but they're another shocking thing for a utility company is their options implied volatility is super high. So to play to the upside, my way to do that, Brian, is to play it with an iron condor. Before I get into that, just looking at this chart here, I'm going to play it through September 19th expiration. 350, of course, previous all-time high. We're currently at 330. Just kind of looking for it to trade above 350 right here by September. So my trade is the 350, 330, 350, 370, 390 condor. So if it's above 370 up here, it will again go back to 375, I guess is my break even, but it'll again lose value. But I'm not expecting it to race through 370. So I'm really expecting it to be in this range, 350 to 370 by September expiration. And here are the legs of the call.
Yeah, so here let's break this down here too. So when you buy a call spread, the 330, 350 call spread, you reduce the cost of that call spread by selling a further higher upside call spread, right? The 370, 390, like Joe spoke to. So the total cost 570. The max gain would occur in between 350 and 370. You would stand to make, let's call it 1430 on this trade, 1430. So you almost triple your money. It has a little bit of a long delta. So option traders, what we call long delta, it means it will appreciate if the stock moves higher. But like Joe mentioned, if it gets above 370, you start to give back money on the trade from the short call spread. And so now your delta flips to a short delta. So remember how that's managed. If you subscribe to our newsletter and pay for the subscription on these trade ideas, we will probably give an indication whether we want to get out of this trade. If it flips to a short delta and we don't want to be short deltas, we might want to close this trade. We may close it just because it has the long deltas. If we see CEG goes higher and maybe this condor goes to $8, $9, $10, maybe that's a good time to get out. So this is a trade you kind of want to manage. You really want to watch it, see if it stays in this sort of trading zone, like we call our show, and keep it priced accordingly. So we'll definitely keep this trade up to date for our subscribers. But
just kind of a broad update on the model. We did close some of our hardware longs. We closed a QQQ long. We closed an Oracle long, where we're long some of these hardware names for the AI trade. I think it's just a little bit of a rotation. I'm still a firm believer that AI is coming. We're still in the early stages of that. I just think there's going to be, for the utilities, maybe it'll be a stage where it's 2 steps forwards, 1 backwards. For the same ththing for the hardware names right now, 2 steps forward, 1 backwards. Some of the software names, maybe 3 steps forward, 1 backwards. We'll watch them play out. Palantir, I think everybody is watching for that step backwards for them so they can buy it again. But if you're interested in the trades, you can obviously check them out. We've been doing this for.
By the way, you got to change for the trade of the week there, the QQQ. That was from last week. This week, right at the top on the slide there, CEG is the symbol that we're trading here. This is a September called in our door. So we'll just remember that going forward. And there you go.
CG.
Right. All right. So yeah, why don't you give a little recap on how we done here, Joe, as traders on our trade of the week, so people know?
Yeah. So obviously, every time you do a trade, you want to have better than a 50% batting average. If you can do that, you're very likely going to be ahead of the game. We've been doing this a little over a year. We have had a total so far of 33 and 19. So not too shabby when it comes to the batting average. But what I'm really proud of is the win-loss ratio that we have, an average win size of close to $1,200, a loss of under $400. So these are trade ideas that we think about. If you like them, you can follow along if you subscribe with us. So our subscribers have gotten a lot more, of course, than just what we put on these show every week. So make sure you check those out. If that's something that interests you, let us know.
Yeah, and these are lined up for one lot trades, so you can sort of price your size accordingly on how much you want to risk based on what we've lost in the past. But certainly that's a pretty good winning record we got going on here. I would take that if I were the Chicago Cubs right now, given how poorly they've been playing over the last month or so. But anyways, yeah, that about wraps it up. I hope you enjoyed our new time slot here, folks. This is Brian Stutland here with Joe Teague of Equity Armor Investments. We're going to be here on this longer version of the show every Monday at noon Eastern time. So tune in. Just if you want to just listen in while you're eating your lunch, it's a great opportunity to do that. We're excited about the new time slot, give you updates throughout the day on the market, plus all our trade ideas and whatnot going forward. So we will catch you next week at noon Monday Eastern time. Catch you then.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.